Hello, everyone, and welcome to Basepoint Wealth's presentation on the One Big Beautiful Bill Act, Implications for Families and Financial Planning, a comprehensive breakdown of the impact on taxpayers, families, and financial planning strategies. We will be covering a lot of topics today, and important disclosures will be posted at the end of this recording. No further delay, I will pass the mic to Alan Wallace and Landis Wiley.
Thanks, Katie. I'm Landis Wiley, host of the Point Podcast, sitting here with Alan Wallace, Chief Investment Officer of Basepoint Wealth. Alan?
Hey, glad to be here.
We're here.
It's football season, so we got to get this done.
It is. Well, we've got a lot to cover today. An 800-page bill passed through Congress and was signed into law back in July.
Just a little light reading.
Just a little bit. I'm glad you did the heavy lifting.
I skimmed.
Well, it was certainly a team effort. A lot of people on the team spent a lot of time researching this bill and figuring out exactly what's in it and what really applies and how. And so, hopefully as we go through this, we can try to break this down and make this a valuable experience for people.
Yeah, it's interesting. It's a really long bill, but it really doesn't do that much. A lot of those pages are spent putting exclusions and limitations into things. It's a little bit like Boolean code, right? So, it takes 10 pages for an exclusion. So there are a lot of things that will impact some of our clients, but it's not really monumental. But we're here to let everyone know the things that they need to know and how to work it into their planning so that they can optimize their tax situation.
Perfect. And like everything, the bill has probably some things that will really benefit folks, probably some things that disappoint some people, probably some winners and some losers as we go through this.
That is the nature of politics.
That's the nature of it. So obviously a big bill, a lot to cover. So without further ado, we'll dive right into this. And, as we talked about how to approach this, just because of the breadth of it, we really wanted to make sure that this presentation was productive and useful for a lot of folks, depending on, if they just want kind of the quick overview or if they want to get really deep into the weeds on it. So you want to kind of break down how we're going to tackle this here today?
Yeah, what we went with was sort of concentric circles of complexity. For those that only have 10 or 15 minutes, we're going to get the headline things out there so you can kind of see what they are and maybe do a little bit more research to see if they apply to you. After that, we'll spend another 10 to 15 minutes talking about actionable strategies and some miniature case studies to just sort of see how the bill affects different income levels. And then for those that really like torture, we'll get deeper into the weeds with all the exclusions and limitations and other things in a detailed analysis that'll be about 20 to 30 minutes after the first two segments are done. So we'll try to flag when we're moving on to a different segment, so those that are losing interest can move on with their day.
Perfect. Well, with that, maybe let's start off with just a high-level discussion here on what's happening inside this big bill. So like a lot of things, there's stuff that's sticking around. There's some things that are going to go away. And obviously there's some new stuff that gets incorporated in here. So you want to kind of talk us through a little bit about what's staying the same for most people?
Yeah, I mean, the biggest thing is the permanence of the Tax Cuts and Jobs Act of 2017. That was Trump's sort of signature bill. A lot of those things were going to expire at the end of this year. And so the tax brackets are going to remain the same. The standard deductions will remain the same. Qualified business income deduction is going to stay pretty much substantially the same. There are a few small changes. The estate and gift tax exemption, the child tax credit, and then the other dependent credit. There are a few things that are going away, though. And so the clean energy credits are going to go away. We'll talk a little bit later about what the deadlines are for that kind of stuff. Residential energy credits, some of the credits that are for electric and hybrid vehicles. And again, it's important to remember that there is a timeline on these. Not all these things go away at the same time. So we'll want to be precise about when each provision is going to be terminating.
Right. We'll dive into that in more detail here in a little bit. So lots staying the same, which is good and maybe helps people that were concerned about how their tax situation or maybe their estate plans were going to need to be adjusted with the expiration of that Tax Cuts Jobs Act. Maybe don't need to worry about it at this point, but there are some new things in the bill, as you would expect, with 800 plus pages to wade through. So what do we got going on?
Yeah, you got to throw a few things in there to keep it interesting, right? So there's the new senior bonus deduction. those that stick around to the end will figure out that that really functions more like the old personal exemptions. There's the SALT cap expansion. The SALT cap is not what your doctor tells you when your blood pressure is high. It stands for state and local income taxes. And then there's also a new sort of headline auto loan interest deduction that may not be much liftoff for most people, but it is in there, and we should talk about it. And then there are some changes to the charitable deduction scheme that we're going to need to talk about. And those don't start till 2026, so we'll have a little bit of time to get those in place.
And one thing that was maybe a little interesting about the new bill is a lot of these new provisions in particular tend to come with introduction of some new income limitations, right? So we'll have to talk a little bit about how that applies to folks.
Yeah, that'll be in a little bit deeper segment. But for now, just sort of the headlines of what the things you can expect are.
So looking ahead here, kind of taking a look at what some of these key provisions are, this bill is sort of wide ranging, affects individual taxpayers as well as businesses out there. So I figured maybe a good way to start this off would just be going through kind of high level what's affecting folks at a broad scale. And let's start off with the individual impacts. There's quite a list of these. So you want to give us a little rundown?
Yeah, and again, remember there are exclusions and limitations on most of these things. We tried to just sort of highlight them here, but it's always a little bit more complicated than you can describe in 3 words. So we've got the new tip income deduction. So important language there is that it's a deduction, not an exclusion. So it comes off at the end of the tax return, not the beginning of the tax return. There, and that's up to $25,000 per tipped worker. So for a married couple, each earning $25,000 in tips, it's $50,000 in the tax return. There's the overtime income deduction. That's up to $12,500 for each taxpayer, so $25,000 for a married couple. There's the senior deduction, which is a $6,000 deduction for taxpayers over the age of 65. Again, that's per taxpayer, so a married couple would get $12,000. Important to remember that that is for both itemizers and those who take the standard deduction. So it functions more like personal exemptions used to. And it's temporary, of course. The SALT cap expansion increases from $10,000 to $40,000 for certain taxpayers in certain income brackets. There are some enhanced charitable deductions starting in 2026. We've got the Trump accounts for children. Those will be for minors under the age of 18. There's some expansions to the 529 plans, mostly what things can be used and the limits. There's a new foreign transfer tax of 1% that'll begin in 2026. There are some Medicare restrictions, especially on immigration, on immigrants, and then there's also a new moratorium on expansions that'll run through 2034. That's really just sort of a budget item to try to keep costs down at the federal level. And then there's some student loan relief provisions that will apply to a lot of people, especially those who have kids who have recently graduated from college.
And one thing you kind of touched on it, a lot of these items in here do have income limitations. So throughout the presentation here, we'll talk a lot about it. Generally speaking, most of those seem to fall in that 150,000 range for a single filer or 300,000 for joint, with a few caveats.
Yep, in general, that's true. There are a couple, obviously, nothing ever follows the template to a T, but there are a couple that are different. But yeah, in general, we're looking at limitations that are 150,000 for a single taxpayer.
Okay, and then on the business side, some key things in here for businesses. Few of them are a little bit time sensitive. So you want to talk us through high level here?
Yeah, so you've got the QBI deduction, which is a deduction for income from pass-through entities. That is going to be enhanced with a new $400 minimum. There's some bonus depreciation, which has been sort of phasing out over the last few years. That's going to be restored back up to 100%. R&D costs are back to being immediately expensed as opposed to capitalized. There's some enhanced Section 179 depreciation provisions. We've got some new student loan provisions that allow employers to help employees with student loan payments and some other educational expenses. The dependent care benefit goes from $5,000 to $7,500. That begins next year. And then the work opportunity credits are going to be expiring at the end of 2025. And that was sort of a catch-all provision for hiring a lot of different groups of people, convicted felons and people that live in economically disadvantaged areas. There's a list of maybe 10 different classifications that employers would get credits for hiring people. And so those will be gone on 12/31/2025.
All right. So as you went through that, you mentioned kind of the timeline associated with this stuff. So some of these things are coming into effect right away. A few of them rolling out over the next year or so. But then there are some expiration dates for people to be aware of, right?
Yeah. So in general, in 2025, you've got the SALT cap expansion, you've got the tip, the overtime, and the auto interest deductions beginning. You've got the work opportunity tax credits expiring. You've got the green energy credits expiring, and then you've got the electric vehicle credits expiring. Moving on to 2026, you've got the new foreign transfer tax beginning. You've got the charitable deduction changes rolling into effect. You've got the dependent care assistance credit increasing, and then the new AMT thresholds will take effect in 2026. 2027, the opportunity zones become permanent rolling designations. And what that means is that every 10 years, they'll determine which economic areas qualify for the opportunity zones. The problem with the previous bill was that it named all the opportunity zones, but then it didn't allow new areas that become disadvantaged to be included. So those will become rolling. And then in 2028, you've got the senior deduction expiring and the tip and overtime deductions expiring. And then in 2029, the SALT cap expansion expires and goes back down to 10,000.
Right. So for people out there, as they're maybe working with their advisors or their tax professionals, there's certainly some timelines just to be aware of if they're looking to take maximum advantage of some of these tax rules.
Yeah, absolutely. You want to get the timing down if you have income that's not necessarily fixed or mandatory. If you're able to shift income between years, or bunch itemized deductions or time Roth conversions in a certain way, you're going to want to work with your advisor to keep these implementation dates in mind.
And for those that were maybe focused in on some of the green energy opportunities out there, putting solar on their house or maybe buying an electric vehicle, obviously those deadlines are coming up pretty quickly.
Yeah, you want to get your solar panels done, I think, by September 30th, and you need to get your electric vehicle by the end of the year. So you're going to need to get moving if you want to take advantage of those things. Yeah.
So aside from impacts to individual taxpayers and to businesses, obviously when you get a bill of this size, there's impacts and maybe motivations that the government itself has in some of the provisions that have been included within the bill. So you want to talk about those impacts a little bit?
Yeah, so there's really four major areas where they sort of stuck non-tax legislation in here. Obviously, the big one is border security. A lot of money allocated to border enforcement and enhanced security measures, increased deportations. There are some defense spending things in here. You've got the Golden Dome missile defense. There's money for shipbuilders and other military innovations. There are some spending cuts. Those things are hitting the news pretty hard. Some reductions in the federal portion of Medicaid. You've got work requirements now for supplemental nutrition and assistance program. And then you've got some phase out of the renewable energy credits that were out there. And then finally, you've got an increase in the debt ceiling, which should allow us to maybe move on a little longer before we have another argument in Congress about raising that.
Right. That'd be nice to have a little moratorium on that for a bit. So I think one of the, as we transition here, maybe moving away from high level discussion, what are the provisions, taking a look at some of maybe the practical effects of some of these provisions for, the average client or the average taxpayer out there. We thought we'd just sort of take a little walk through and look at a couple case studies.
Yeah, and for those of you tracking at home, this is where the executive summary ends. So if you just came for the first few minutes, then this is your opportunity to get out of here.
Perfect. So when we talk about a lot of the provisions in here, we mentioned varying income thresholds where things are phasing in, phasing out, what have you. So probably one of the easiest ways to do this is maybe take a look at this from a individual tax filer standpoint or a household tax filer standpoint, and just look at, how is this bill likely to benefit folks at different ranges that show up on their tax return. So if we were to look at maybe that threshold of, we'll just call it up to 150,000 of household income. What are we seeing a lot of these provisions come through as far as impacts to those folks?
Yeah, it's important to remember these are rules of thumb. Obviously, everyone's situation is different, but I like this case study approach of, if you're in this income band, then these are the key things that you want to focus on. So for the $50,000 to $150,000 sort of income range in household earnings, you've got the permanence of the TCJA tax brackets and the standard deduction. You're going to have full tip income deduction of up to $25,000. You get the full overtime deduction of up to $12,500, and then you've got the child tax credits increasing to $2,200. And so the optimal positioning here is you're going to receive the full benefit from the new deductions that have been added. The lower income is going to see the largest percentage increase to their total take-home pay. And this particularly benefits workers who earn tips, those who work overtime, and those who are over the age of 65. So the optimal position for this portion of the bill is a 65-year-old who's picking up double shifts at Chili's.
Perfect. Yeah. So at this age range, really any of the new perks, if you will, that are included in this bill, as far as credits or deductions, they're really likely going to be able to maximize the opportunity of those, right?
Right.
And then as we move along, kind of look at this next range, which we've looked at from 150,000 to 250,000. What do we have going on here?
Well, so obviously the benefits are a little bit less pronounced, right? So you still got the permanence of the TCJA tax brackets and standard deduction. Now you're more focused on the enhanced SALT deduction of up to 40,000. You will start to get some limitation in this range, but at the lower end of the range, you're going to have more deductions for your state income tax and your real estate taxes, a couple other different taxes in there. And then you've got some new deductions that might apply depending on where you're at in the range, and a few other things. So, but you have to keep the phase outs into consideration. Most of these new deductions will start phasing out when a single taxpayer hits 150,000 of AGI. And so as you get up to the upper range of this income band, you're going to start losing the majority of those benefits.
Right. So whereas that lower income range really pretty much had open book as far as taking advantage of things, if you find yourself in this range, there's probably a few more conversations with your advisor or with your tax professional as far as figuring out where you fall and what's going to work for you.
Yeah, and also proactive planning, right? So, if you're real close to a band, you might be able to increase a 401k contribution to get your income down a little bit. If you don't have a retirement plan, you might be able to make an IRA contribution. So you might be able to time or bunch the timing of your charitable contribution. So I think there's some really key planning considerations in this income band, and working with your advisor can really help you go a long way towards maximizing these benefits.
Okay, and then as we move along, for those over 250,000, I think for higher income ranges, folks are probably pretty accustomed to having to pay close attention to phase outs under the previously existing law. That doesn't really change here, right? There's going to be a lot of things that need to be discussed with advisors to figure out how to best take advantage of some of both the existing provisions that are sticking around, as well as some of the new things, right?
Yeah. So in this income band, obviously the new tax or the tax brackets are going to stay the same. So you're not going to raise back up to 39.6 where you were before. So you're going to take advantage of the existing lower tax brackets. You might be able to get some enhanced SALT deductions depending on where you fall in the income range. The big thing here, though, becomes a little bit more on offense as opposed to defense. You've got the higher estate tax exemptions. So, permanently raised to 15 million for a single taxpayer and 30 million for married filing joint. And then you've got some enhanced business deductions also. A lot of times we find that business owner clients are in this higher income range. So, you've got the QBI, which is also called 199A. Those are interchangeable. And then you've got the extra depreciation, both the bonus depreciation and Section 179 depreciation. So most of the new things, the headline stuff, are completely phased out once you hit this income range. There's also a limitation on itemized deduction of 35 cents on the dollar. And then the AMT will come back in the next year or two for couples that make over $1 million. And so that will be a little bit more onerous as far as how much income tax they end up paying.
Right. So definitely more of a mixed bag of effects for these folks.
Right.
So aside from just looking at things from an income band standpoint, we have a lot of clients at Basepoint that have worked with their advisors and worked with their tax professionals over the years and had conversations around different tax management strategies. One that's been increasingly popular in recent years is looking at the opportunity for Roth conversions as a way to manage both current taxation as well as future taxation, especially for those that maybe have accumulated large pre-tax retirement assets. And so one of the practical impacts of some of these provisions in the OBBBA is how that may spill over and affect the conversations that have been happening around Roth conversions.
Yeah, this is one area. I mean, obviously there's many others, but it's sort of one that we want to highlight because you do have some opportunities here over this multi-year time horizon, but you have to be really careful. And there are opportunities with the lower tax brackets and some of the temporary deductions, but when you're creating income, you start to limit those things that you're benefiting from. So you really have to balance between taking advantage of the lower tax brackets and then forcing your income up to a range that's going to limit those deductions. So working with your tax advisor and your wealth advisor on an annual basis, especially from 2025 to 2028, is really key because you've got sort of this window to reduce your future distributions. So you really need to focus on multi-year planning because you have opportunities, but then there are also complications when you force your modified adjusted gross income up and start losing some of those other deductions.
Right. And it's been typical when having these conversations around conversions, particularly for folks that maybe are at higher income levels or doing larger conversions, where we've had to worry about the IRMA provisions around Medicare. And now with some of the limitations on the new senior deduction, that's just become a complicating factor in these discussions.
Absolutely right. And that's one of the reasons why it's so important to work with a wealth advisor that, has not just this year's taxes in mind, but future taxes as well. It's not enough to just look at what this year's tax return looks like. We have to model out what your taxes are going to be like over the rest of your life to the best of our abilities. Obviously things change, but we have to base it on what is available today.
Right. And you kind of touched on estate planning impacts in the earlier part of the presentation there. We thought this would be something to really take a closer look at because this has certainly been a major focal point really for the last couple of decades as exemption amounts have gone up, threats of them going down. But one of the things key with the OBBBA is that some of the new higher exemption amounts have been made permanent. So that certainly is going to help out from a planning perspective.
Yeah, I mean, this goes all the way back to my first year in the business when they first started tinkering with the estate tax limitations, and it's sort of been a constant situation where we're going to have to constant monitoring situation every couple of years as these things sunset to see what's going to happen. Are we going to go back down to 600,000? Is it going to revert to 1 million? Well, now it's permanent and it's 15 million per person. So that really creates a lot of flexibility in estate planning. It is cause for most people to probably review their estate plan, especially if they're in a higher net worth range, just to make sure that there aren't unnecessary provisions in there that are going to complicate their estate for the surviving spouse. But you've got some larger tax-free transfers here, both on the annual gifting and at death. You're going to be able to simplify your estate structure. There's less need for unified credit trusts and marital trusts. You can take advantage of some of the new enhanced charitable giving rules. You can streamline your business succession here, right? Because you don't have to worry as much about having to liquidate a portion of the business to cover estate taxes. That's especially true for farmers. That's sort of always been the big downside to estate tax in Iowa is that, you own a farm, you're not always liquid. So, there are too many examples of someone having to sell half the family farm in order to pay taxes. So some of the things you want to keep in mind is that the unified credit system is still going to be around because you're going to have to still monitor your annual gifts and your lifetime gifts. You should really take this as an opportunity to review your estate plan, make sure that it still functions in the current environment. Keep in mind that this is a federal law and that states may vary. So just because the federal estate tax is much less onerous. Doesn't mean that your state doesn't still have some sort of inheritance tax. And then, obviously there's a great deal of variance in how this impacts you based on how much your net worth is.
And probably one of the key things you sort of mentioned it briefly there is there's probably some folks that may look at this and say, oh, well, with that exemption, I don't really need to worry about my estate plan. But the reality is, with all the changes over the last couple of decades with thresholds going up and down, really everybody should probably take it as an opportunity to go back and look at their plan, make sure that whatever they put in place 5, 10, 15 years ago wasn't structured for a more complex estate planning scenario than what we're going to see under the new law.
Exactly right. And then also your situation has changed, right? So there's the passage of time, which changes your situation. And then there's also the change in the rules. So it's a double whammy at this point. You should just, take a look and, work with your advisor to see if you should meet with your attorney.
Okay. So we've covered a lot. Maybe it'd be good just to sort of summarize this back a little bit and talk about, there's obviously short-term immediate impacts that are going to affect individuals and businesses, as well as maybe some longer-term impacts to this law. Let's maybe start off and just, summarize this up. What are some of the most short-term immediate impacts that people and businesses are likely to face here?
Like almost anything, the benefits are in the short run and the costs are in the long run, right? So I think the most important is immediate tax relief, right? So in the first 2 years, you're going to get the most bang for your buck here. You've got some spending boosts for individuals and businesses, and then you've got some direct tax benefits. You've got some retirement planning considerations over the short term, especially with the new senior deduction, which is only going to last for a few years and expire in 2028. And so this may require a slight adjustment to your retirement income strategies, something you should work with your advisor on. And then there's a little bit more certainty in the business planning area. A lot of these things that used to be tinkered with on a frequent basis are now either permanent or, back in force for a few years. So the business planning is going to allow a little bit more certainty when it comes to cash flow modeling and profit modeling.
And then on the other side of it, we got the long-term impacts.
Right. Yeah. The costs are always in the long run, right? That's how they get you. But and this is just, these are potential considerations. We don't know how this is going to impact us. But if you look at the way the bill is structured, there's a $3.5 trillion increase in the federal debt over a 10-year period, and then there's also a $5 trillion decrease in total revenue. So that's obviously that could increase financial strain. When you've got an extra $3 to $5 trillion that needs to be financed through debt issuance by the United States government, it could put pressure on the budget. It puts pressure on interest rates, and rising interest rates might be a headwind to everyone's investments. So it's something that you want to keep an eye on. Higher interest costs, obviously. So if longer term rates rise because of debt issuance, that affects things that people really spend money on. That affects your student loan rates. That affects your mortgage rate. That affects your auto loan rates. So higher interest costs to everyday consumers could be an issue over the longer term that we need to keep in mind here. And then there's a lot of regulatory reform that's kind of tucked into this bill. The big one is the REINS Act, it requires any significant regulations to get congressional approval. Over the Chevron doctrine period of the last couple decades, there's sort of been free reign for the federal agencies to make their own regulations, which I think they got a little bit out of hand with. At some point they were issuing 30 or 40,000 pages of regulations a year, and so Congress is sort of trying to control that, and they're requiring their approval on major regulations to sort of kind of slow down that regulatory burden that we've been facing. So some supporters of the REINS Act are projecting up to $1 trillion in deficit reduction over the next decade. So could be positive, could be negative. We'll see.
Right. And like you said, we don't know how this is all going to play out. And obviously the pitch behind some of the tax reform or the benefits to businesses with streamlining of their planning, ideally that the hope there is it would spur growth, which could offset some of the costs. Right. But Obviously, if we are looking at increased deficits in the future, aside from the impact on interest rates, presumably that comes along with the need for more money printing, which could potentially raise inflation too. So it'll be maybe interesting to see how it plays out.
Yeah, unfortunately, it's like a Rube Goldberg machine. You drop the marble in, you're not sure if the cat's going to get scared at the end or not. So we will find out. You kind of just have to set the machine running.
Yeah, we'll wait with bated breath.
That's right.
So kind of looking at all of this in a nutshell, what are some maybe immediate, just high level action items that folks should be taking into consideration here?
Well, first and foremost, whenever there's a major tax change like this, which seems to be happening more and more frequently, the big tax act when I started the business was 1986. Well, now it seems like we have one every 4 or 5 years. So that may not be necessary because a lot of these things have been made permanent and the cost of living adjustments have been built in. But most importantly is review your financial plan. Work with your financial advisor. Don't try to do this on your own. We're working with hundreds of cases and clients here. We're figuring out how these provisions work. So work with your advisor to figure out what applies to you and how you can best maximize it. One of the major areas you can revisit is the charitable giving strategies. I would also add Roth conversion strategies to that as well. Check to see whether bunching deductions before 2026 will help you out, or whether it's better to spread them out to leverage the sort of new non-itemizer deductions. Check on your Roth conversions and see what the optimal amount is, so you get the major benefits of the new deductions, but you don't phase them out or have an IRMA problem. And then finally, just stay informed. We're basing all this on the law itself, but Treasury will start issuing regulations at some point. And so, we don't have 100% certainty that all these things will be implemented the way that we want them to.
Right. So stay tuned for more.
As usual.
All right. And as we make a transition here, this is the exit ramp.
It's time for the punishment.
Time for the punishment. So we're going to take the next segment of this presentation and kind of do a deep dive into some of these provisions that we've touched on at a high level.
It's fine. It's only 150 slides. No, I'm kidding. It's nowhere near that.
All right, so let's start off and maybe dive in on the individual side of the bill first. We'll get to business provisions here in a little bit. So on the individual side, we touched on some new income deductions that are available to a few folks with some caveats.
Yeah, so the tip income deduction, and again, remember, it's a deduction, not an exclusion. So it comes off at the end of your tax return, not the beginning. So anything that is affected by modified adjusted gross income is going to come into play here on your pre-deduction income. So this is going to be phased out at $300,000 for married filing joint taxpayers. It starts to be phased out at $150,000 for all the others, head of household and single, married filing separately. And this is only effective for 2025 through 2028. So let's keep that in mind. And then sort of the other side of this coin is the overtime income deduction. It functions relatively the same way, but except for it's $12,500 instead of $25,000 each. And then you've got the phase out rates as well for this provision. So we have a little numerical example on here. So if you earn $90,000, you had your standard deduction of $15,000, you would have a taxable income of $75,000. Under the new rules, taxable income is $90,000 minus your standard deduction of $15,000 minus your overtime deduction ends up a taxable income of $62,500. But the importance here is that this is coming off at the end as a deduction. It's not reducing your modified adjusted gross income. So the tip income itself could cause it to be phased out.
Mm-hmm. All right, and then some new changes to itemized deductions for folks.
Yeah, so on the casualty and property loss side, state declared disasters are now qualified. So it used to only be federal declared disaster areas. The qualified educator expense is now an itemized deduction instead of an adjustment to income. And then the wagering losses have been tinkered with here. It used to be 100% of your losses up to your gains. So you could never take a loss above what you earned in income. But now they've sort of put a haircut on there, and you can only take 90% of your losses. So, if you lost $100 but you won 200, you can only deduct 90.
Okay. So pay attention out there, all you gamblers.
That's right. Yeah.
All right. And then we've got a few other provisions floating around that we thought it'd be good just to talk about in a little more detail here.
Yeah, so the foreign transfer tax is going to be a new 1% excise tax when you transfer money to someone in a foreign country. There is a lot of money transfer that goes on between the United States and in other countries, and that has been going on for many years. Institutions like Wells Fargo are make a lot of money on money transfers. But so now we're going to have maybe just a small speed limit on that money being transferred. There's some new alternative minimum tax guidelines. So this will begin in 2026. And it's really going to focus on taxpayers who are over $1 million in income. So watch out for AMT items. So the new adoption credit is partially refundable, which means it can actually create a negative tax burden. A lot of times credits are not refundable, which means it can only reward you up to the amount of tax that you paid. But now the adoption credit will be at least partially refundable. And then you've got some increased FSA, which are flexible spending account limits. So this will allow families to put a little bit more aside to pay for things like healthcare expenses.
Mm-hmm. And particularly on that FSA contribution limit change, it's probably important to note that's the first change in a long time.
Yeah, it's been decades. It's been $5,000 forever, and it's going to go up to $7,000.
Right. And we've mentioned this several times. There's really some specific targeted relief for seniors or those over 65 in the Act.
Yeah, so you got the new income-based deduction, which we talked about earlier. Kind of it functions kind of like a personal exemption used to. So it will apply even if you itemize. You'll get an extra $6,000 deduction, and that is per taxpayer over 65. So if a married couple, if both partners are over 65, they will get $12,000. That is phased out based on your modified adjusted gross income, and it's temporary. It's going to expire in 2028. So if you're single, you get the full deduction up to $75,000, and then it has basically $100,000 phase out range. And if you're married, you get the full deduction up to $150,000, and again has a $100,000 phase out range. And it's basically 6 cents per dollar over the threshold. So we can do some math and figure out whether you're going to get phased out based on different planning items that you're going to be focusing on. So the impact is that about 88% of retirees are expected to pay no tax on their Social Security benefits, and it should increase, and that's an increase from 64% currently. So significant tax relief to seniors here. And then we have a disclaimer on here to remind you that this is only going to happen on your tax return. They're not going to adjust your Social Security payment.
Right. And there's been some headlines around potential changes to Medicare in here. And so we thought maybe it'd be important just to talk about what that really means in the scope of this bill.
Yeah, this is a hot button issue. This is what a lot of the media is focusing on, and probably for good reason. But so there are going to now be some stricter enrollment restrictions on enrollment in Medicare. So only U.S. citizens and certain legal immigrants can enroll. Others are going to be excluded. And so if you're currently non-compliant, you will begin to lose your coverage by January 2027. There is a moratorium on Medicare savings programs. This one is kind of confusing, but the point is that states can't expand them or open them up to new groups of people. And this is projected to save about $66 billion. This is one of those things they stick in there so that when they do the tally at the end, it can say it's only costing us this much money because this is an addition to income here, but estimated to save $66 billion over the projection period. And then there's also some impacts on nursing homes. So the minimum staffing rules have been removed. The drug price negotiation power may cause the trust fund to accelerate its depletion. And so those are things we're going to want to keep an eye on.
Right. And with the bill, there's some new investment vehicles being made available to folks. The Trump accounts have drawn some headlines.
Yeah, this one is a little bit confusing. It's basically an IRA for a child The major difference is the maximum contribution, and then that you don't need to have earned income, obviously, to make it. Certain children will have $1,000 put in there by the federal government. Um, there's an allowance for employers to make contributions to minor accounts, both for minors that are working for them and also for children of employees. That's $2,500. And then basically, once the child turns 18, it converts into an IRA. Now, whether it'll be called an IRA at that point or a Trump account, that's going to be left up to regulation. But for all intents and purposes, once the minor is 18 years old, this functions like an IRA. So there's still a 10% penalty. It's still taxable. There are some exceptions like education and first-time home buying. So basically, you're going to follow the IRA rules. Then there's also some 529 plan expansion. This should help a lot of people who are either homeschooling or using non-traditional methods of schooling. So credentialing can now be a qualified expense. So the per child annual cap is increased to 20,000 from 10,000. And then, it's just, it makes the rules a little bit more flexible in general.
Right. Kind of continuing a trend we've seen in recent years of them expanding some of the flexibility around 529 plans.
Exactly. Yeah. You had the ABLE accounts go into effect, and now you're able to use this for homeschooling expenses and a few other types of expenses.
And then one that obviously impacts a lot of people in the country is student loans. And so the new bill does include some changes and some extensions to certain provisions around student loans. You want to talk about those?
Yeah, so the interest deduction has been expanded. So it's going to be raised from $2,500 to $5,000 for individuals and $10,000 for joint filers. There are some critical professions where they will receive some student loan interest forgiveness, and so it'll be entirely tax-free, and that'll end in 2032. We discussed earlier, there's the new $250 deduction for employers to make contributions to their employees' student loans. That'll be excluded from the employee's W-2. And then, there's the plus graduate loan, retirement, and then the expansion of the student loan caps. So by July 2026, the plus graduate loans will go away, and then the new caps on student loan borrowing will be implemented.
So again, another thing with lots of timelines involved here.
Yep, you're going to want to have the pencil down to figure out when all this stuff happens.
You mentioned earlier around the estate tax in particular, that just because something changes at the federal level, it doesn't necessarily mean that it's going to jive with what's going on at each individual state level. But that's not really the only area where that comes into play under the new law.
Right. Yeah, so you just kind of have to know what type of state you're in. So there are some states that have rolling conformity, which means when the federal government makes a change, they change with it. And then there are some that have static conformity, which means that they have to pass separate state legislation in order to match up with federal regulations or laws. And then when those change in the future, they sort of stay where they were. So that's important to know whether your state is gonna coordinate with the One Big Beautiful Bill Act. And then the SALT cap benefits are going to be widely varied by state. Iowa's been sort of reducing their state income tax over the last few years, so less beneficial than it was before, but still impactful to a lot of our clients. There's still the PTET workaround, which is that's something that's relatively obscure, but it's the pass-through entity tax. So if you own a limited liability company, you can elect to pay the tax at the entity level as opposed to the individual level. And that allows you to take the full state income tax deduction. And that's something that if you currently have a business and you are subject to the SALT cap, you should work with your advisor, both your tax advisor and wealth advisor, to see if a PTET workaround is something that could function for you. And then there's some small changes to the qualified small business stock treatment. So you want to check your state law to see if it's going to conform with federal law.
Okay, so moving on then into some of the impacts on businesses. You've touched on a number of these. QBI has been a big one the last several years. You want to talk a little bit about some of the details of these changes?
Yeah, so the QBI has some new phase in amounts increased. So there's a $400 minimum deduction for taxpayers. So that's basically a 40% credit instead of a 20% credit at the very small end of self-employment income. And there's some expansions to the bonus depreciation. It's back up to 100%. It was being phased out. Section 179 bonus depreciation has been doubled to 2.5 million. So that includes a wide range of different properties, machinery, equipment, software. So that will help with deductions at the small business level. And then R&D costs are back to being expensed instead of capitalized. So since 2022, you've been required to capitalize your R&D expenses and then amortize the expense over a number of years instead of being able to take the deduction right away. So that helps with innovation. It helps smaller companies and companies that are trying to sort of develop technological innovation.
And it's tough when you're having the outlay of cash this year, but you're not able to recognize the deduction for it for several years.
Yeah, so phantom income in a business is one of the most dangerous things that you can encounter when you have money coming in that's taxable, but there's an expense that has to be paid that isn't deductible. So you basically need to earn more than your expenses just to break even.
Mm-hmm. So hopefully this will be a thing to maybe streamline that a little bit for businesses and maybe make them a little bit more willing to take on some of those exploratory expenditures around R&D and other items.
That's right.
And then aside from direct benefits to the businesses, there's some focus provisions in here to benefit the employees as well, right?
Yeah, so we talked about the employer payments for student loans under the employer side, but also it's an employee benefit, right? So working with employers to have tax-free contributions and deductible contributions to the employer for student loans could be good for both sides here. There's the $5,000 tax-free dependent care benefit per employee, which is already going to increase to $7,500 in 2026. And then there's the changes to the C Corp charitable deductions. So it's still limited to 10% of taxable income, but there's now a 1% floor for charitable deductions, which in some circumstances can be carried forward. So a slight limitation to C Corporation charitable deductions.
And then for businesses maybe looking for opportunities to grow or expand or invest in new areas, there's some impactful changes too.
Yep, we talked earlier about how they're going to change the opportunity zones to rolling. So that's going to begin in 2027, and then 10 years later they will reclassify the opportunity zones. So that supports development in low-income communities. It gives tax benefits to invest in areas that are maybe underprivileged or underserved, and it allows capital gains to be deferred and potentially excluded depending on how it works out. And then just a side note on the section 1202, the eligibility and holding period for qualified small business stock has been amended.
We've covered a lot of ground, and I think we're getting to the end of this thing. So do we want to kind of hit the final summary if we're going to wrap it all up together?
Yeah. So, I mean, obviously the permanence is a big deal. So many of these provisions that have been sunsetting and renewing, in some cases for decades, are now permanent. And a lot of the inflation adjustments are also permanent. One of the big things in the past was to put something new in, especially the law of 1986, put a lot of cool things in, but it never adjusted them for inflation. So they became less and less impactful over time. Well, now a lot of these things are permanent, and also the inflation adjustment is permanent. There's new opportunities for people who earn tips or who work overtime, for seniors. There's a little bit of a shift in the tax deductibility of vehicles. So now it's assembled in the US as opposed to electric vehicles. There are the advantages to businesses, especially with bonus depreciation and section 179 depreciation. Being able to expense your R&D as you pay for it is going to be helpful to innovative companies. And then also some employment credits for business owners. And then the important thing to remember is that this bill isn't free. It cuts taxes for a lot of people, but those expenses don't necessarily all go away. There's still a $3.5 trillion increase in debt specifically from this bill. So it's something that we want to monitor, especially on the interest rate side, to make sure that it doesn't put pressure on our investments.
Right. And, as we've gone through this, it's a big bill. There's a lot of pages to it. Obviously some impactful changes, but it's not necessarily as sweeping as maybe folks would hope for or wish for, but certainly not anything to be ignored.
No, I mean, it reads like stereo instructions. It gets a few things done. A lot of pages dedicated to exclusions and limitations. But at the end of the day, it will help a lot of our clients. And so, I think it's important to take all these things into consideration when we're doing our financial planning.
Perfect. Well, hopefully the folks that have been listening in today have found this valuable. Covered a lot of ground. As you mentioned a couple of times, stay tuned for more, because there's going to be more rules around how exactly some of these provisions get implemented. And we'll just kind of have to wait and see.
Yeah, passing the bill into law is the starting line, not the finish line. So now we get to go to the executive branch and start writing regulations. But you do have the REINS Act in force now also. So, there might be some bickering back and forth between Congress and the executive branch, depending on, who's in charge after the midterms. So stay tuned and we will keep you posted.
Perfect. Well, thanks, Alan. And again, thanks to those out there who have joined us, and for those that survived all the way through the deep dive. Take care.
Thank you for attending Basepoint Wealth's presentation on the One Big Beautiful Bill Act. If you have any questions, please contact your advisor directly or call us at 319-826-1898. Have a great day.